All right, let's dive straight into this explainer and unpack a macro paradigm shift that is fundamentally rewiring the Australian economy right now. Look, if you're managing capital in this market, you already feel the ground shifting under your feet. But the sheer scale of this transition, moving completely away from a legacy built on property finance and debt and towards a brand new strategic resource and energy foundation, well, it's massive, and it's something we really need to unpack together today.
As financial analysts and strategists, we have to ask the hard question. Is the current economic pain just a cyclical blip, or are we looking at the absolute end of a 3-decade era? For over 30 years, Australia experienced this unprecedented economic rise, largely immune to the worst global downturns. It was the miracle economy. But the data we're parsing today strongly suggests we're crossing a major threshold. We aren't just waiting for the next rate cut to kickstart the old engine anymore. The entire engine is being swapped out.
Here is our roadmap for today. We're going to cover 1. The dawn of the stagflation era. 2. Fuel security and supply shocks. 3. The property debt trap. And finally 4. The sixth wave pivot.
All right, let's kick things off with part 1. The stagflation era begins.
So here's the crucial takeaway right off the bat. This isn't your standard run-of-the-mill cyclical slowdown. We're seeing real economic momentum stall out entirely, while inflation, well, it's just stubbornly sticking around. This is the literal textbook definition of structural stagflation. What we're experiencing is that the inflation problem isn't just a symptom of some overheated, booming economy anymore. Instead, it's a persistent drag on living costs, happening at the exact same time that productive growth is flatlining.
Think back to that perfect storm of triggers from 2021 and 2022. They engineered this severe supply-side inflation without any strong real growth to back it up. We had global supply chain fragmentation driving up core costs, while energy shocks absolutely spiked utility and transport overheads. Then you throw in that massive post-COVID liquidity rush, which artificially inflated assets alongside widespread labor shortages and a total collapse in housing affordability. Put it all together and you've got a massive structural squeeze that completely chokes consumption while keeping prices painfully high.
Moving right along to part 2, fuel security and supply shocks.
Now, this is wildly ironic, right? Australia is this massive resource powerhouse, but at its core, it is fundamentally fuel insecure. We're a mining giant relying heavily on imported refined fuels and incredibly fragile global shipping routes. Because we have such limited domestic refining capacity, the second fuel prices surge or global shortages hit, it acts as a silent, cascading tax on the entire supply chain. It pushes up transport and logistics overheads, drives up food and construction costs, inflates operating expenses for that all-important mining sector, and directly drains household disposable income. This is pure supply-side inflation, and honestly, monetary policy alone really struggles to fix it.
That brings us to part 3, the property debt trap. Building on that vulnerability, let's stack Australia up against the US for a second. The contrast in resilience is stark. Unlike American homeowners who are mostly shielded by 30-year fixed mortgages, Australian households are fully exposed to floating rates and carry significantly higher household leverage. The Australian dream of homeownership has essentially morphed into a reality of crushing floating rate debt. Because everyday consumption in Australia is so heavily tied to housing wealth, every single rate hike immediately triggers severe mortgage stress and rapidly suffocates discretionary spending.
We're looking at a deeply entrenched system here, a top-heavy structure built on tax engineering, leverage incentives, and negative gearing. The entire Australian property boom wasn't just driven by a simple lack of housing supply, It was deliberately engineered by policies that heavily encouraged immense debt expansion. And now, any potential reform to negative gearing or capital gains tax concessions threatens to fundamentally disrupt this model. If investor demand drops and credit creation slows, this post-1991 economic engine faces a profound and likely irreversible structural break.
Now, those property-driven forces, they were the absolute engine room of the fifth Kondratiev wave, the long-term economic cycle of the last few decades. But as you can see, every single one of those foundational drivers is weakening simultaneously. The tailwinds that lifted Australia for decades, relentless globalization, the insatiable Chinese property boom, ultra-low interest rates, and endless debt expansion, they're all fragmenting, slowing down, or entirely constrained. We are officially in the transition zone, exiting that fifth wave.
Okay, on to our final section, part 4, the sixth wave pivot.
All right, here's where we flip the script, from structural risk to massive portfolio opportunity.
We are witnessing a historic transition of capital away from housing finance, migrating directly into the resource, mining, and energy infrastructure landscape. The footprint of mining, manufacturing, and the electricity sector is heavily dominating states like Western Australia, Queensland, and the Northern Territory. The new capital expenditure is migrating precisely as the old debt-driven model runs out of steam.
Capital is on the move, actively shifting into 4 distinct stages of a new jugular cycle. A medium-term investment cycle representing a massive departure from the old credit expansion model. We're looking at a fundamentally new resource strategic investment phase. The growth engines of tomorrow are the aggressive extraction of critical minerals, the absolute necessity of expanding national electricity grids, meeting the incredibly intense energy demands of new AI data centers, and building out hard, strategic industrial infrastructure.
So, what's the new playbook? As Australia enters this transition zone of the sixth wave economy, these specific strategic sectors will absolutely anchor the next era of industrialization and growth. For investors, AI, energy infrastructure, and rare earths sit at the absolute top of the strategic priority list. Lithium, battery minerals, and a rising focus on sovereign defense manufacturing are also essential pillars, with renewable energy exports providing a massive long-term horizon. Guys, this is a complete foundational pivot from property financialization straight into strategic resource capabilities.
So what's the baseline scenario moving forward? Well, it's not an apocalyptic economic collapse, but it's definitely not another 25-year housing boom either. Rather, it's a structural reality much more similar to Canada, the UK, or Western Europe. We're looking at a future defined by slower productivity growth, a persistent squeeze on living costs, and periodic inflationary spikes. It's a grind. And it means the easy beta returns of the last 30 years, they're gone. Success in this new era requires highly targeted strategic capital allocation.
So here's the million-dollar question I want to leave you with today to spark your own strategy discussions. Exactly how are you adapting to this massive structural break in the post-1991 model? Are you still sitting around waiting for the old property and debt engines to magically restart? Or are you actively positioning your capital into the electricity grids, the critical minerals, and the industrial infrastructure of the emerging sixth wave? It's a brand new era for the Australian economy, and the time to adjust your paradigm is right now.